What's up, everyone? How you doing today? Let me enable the chats. There it is. Hello. We them boys. All right, real quick. Who's excited for this class? Day 2. We'll go over some charting basics today. How did you guys do today? How did you guys perform? You know, damn, yeah, futures are dumping. I wish I swung puts, bro. I won't even be able to trade tomorrow for the first 3 hours, so it's gonna be a bummer. I'm gonna be in a flight. But wow. I just hope tomorrow doesn't, I just hope it's one of those days where we get a big dump after hours and we don't get nothing much. We don't get nothing much for the rest of the day. What did you guys trade today? What did you guys trade today? And did you make money? I didn't come into the market until like an hour later. And, the only 20 minutes I traded, I made like 18K. Sometimes you, okay, for example, let me just show you something real quick. And it's gonna make sense. For example, right? Let's say I came in the market. So I came in the market right here. I'm gonna highlight the moment I came into the market. The only 20 minutes I was in the market. Now, if I came into the market in the morning at the open, right? And I had my levels, obviously. So if I came into the market in the morning, what do you think would have happened the first 20 minutes or the first 5? I usually trade the first 5 minutes sometimes, most of the time. What do you think I would have done the first 5 minutes? Let me get SPY. I want you guys to kind of have an idea of how I think. Okay. This is when I traded. Actually, no. Yeah, this is when I traded. I made 18,000 from here to here. Let me show you. So from point A to point B. 5, 10, 15, yep. In the morning, I probably would have, I don't know. I risked 56,000 to 60, and I made almost 20. I made a total of 37% on my trade. So just do the math. Okay. But I think I would have bought puts at the open and then get faked out and then try to buy calls and get faked out on that. Right? Because honestly, okay, I'm going to tell you this. I'm going to be like, okay, well, look, honestly, if you're looking at pre-market and after hours, right? If you're looking at pre-market and after hours, you always need to figure out the tops and the bottoms of pre-market and after hours, right? Which is, I'm gonna highlight it and make it bold for you to see. So this is the support of after hours and pre-market, and this is the resistance of after hours pre-market, right? So I'm gonna draw it out for you. I'm gonna highlight the areas that, these bounces is what makes this a range, right? So we had a range pre-market and after hours. Now, these bounces is what makes up this range, right? This is why it's called a range, because of these bounces. Now, coming into the market in the morning, you know, sometimes because usually you need to wait for the pre-market levels to break out. Am I wrong or am I right? Before entering a trade, you should wait for the pre-market high or the pre-market low to break out, usually. But sometimes when we're trading in the moment, we tend to do what? We tend to overlook that, and we get caught in the moment, and we get caught in the hype. And then what happens is we end up trading anyways. Okay, we make really impulsive decisions because we're like, oh, we can't. You know, sometimes you catch FOMO. You see a candle, you catch FOMO, right? But obviously, I didn't trade the open because I was waiting for the range to. I was waiting to see what happens when it hits these ranges, right? So at first, I was watching the market, saw this, right? We bounced and then saw this coming back up, right? And the reason why I didn't trade this bounce back up is because I don't like to trade little bounces in the morning because honestly, right? Coming into the market, my thing is always to not trade within the pre-market and within the after hour range, right? Because you can always get stuck in the middle. Now, the trade that I make, was it within the range? Yes, it was within the range. And I'm going to explain why I made that trade. But I'm going to explain why I didn't take the first reversal. I didn't trade the first reversal because at the open, right? What happened right at the open? We dumped right here. Right? We dumped right here. So if we dumped right there at the open, I'm assuming that this area is filled with what? I'm assuming that this area is filled with sellers. So I'm like, you know what? I'm not even going to freaking, you know, try to trade the bounce if we're only going to get hit right here, right? Because in the first 30 minutes, that's when you get the most volatility, right? Let me find the exact time I traded so I can show you. So yes, I usually wait for pre-market high or pre-market low to break out of its own range before I even make a trade. 10:40. Where's 10:40 my time? Hold on. So I enter my puts. 10:56. Oh, I'm sorry. My bad. Wrong one. Huh? No wonder. I traded here. I was like, I was not in there this early. I traded this right here. This whole thing. All right, cool. So I signaled the trade at about what 10:35, around 10:40 my time. So that's what 987. That's like an hour into the market. Okay. So the reason why I didn't trade the open was because obviously I was waiting for the range to finally break out to the downside or to the upside, right? Now, sometimes I do trade the open because we've already broken out of the pre-market high or the pre-market low. So this is the pre-market high and this is the pre-market low. So in the morning, when I saw this type of volatility, right, what exactly made me not trade this? And the reason and the fact that I didn't trade it, did I avoid, and I want you guys to answer this, did I avoid a fake out or not? I avoided a fat fake out. Now, how do you do this, right? If you, for example, like you, right, Kevin, how do I avoid a fake out like how you did this morning? Is that what you're asking me? Would you guys like to know that? So in order for you guys to avoid a fake out like this is if right? When you're looking at the market, right, you find the pre-market high and you find the pre-market low. Now, the open is always the most volatile, so you have to sacrifice that time to just do what? You have to just wait and watch how the levels get treated. Because if you trade before it breaks the pre-market and before it breaks after hour support or high, at essentially, what are you doing if you're just trading it without even waiting? What is that considered? You're just kind of gambling at that point, right? Because it can go anywhere, right? When you make a trade, you need to have some sort of assertion that it's gonna go the way you think it's gonna go, right? You have to have some type of conviction, and your conviction can't be based off of a FOMO that you caught, right? You can't catch FOMO and then enter a trade and justify it. Just meaning you can't justify it as a good trade because it's not. So in the open, when the market opens, you have to wait to see how it treats the high and the low, even if you gotta wait fucking 20 minutes. Now, let's say this never happened, and let's say once we came up here, we broke out here. Now, would this be a good trade if we broke out to the upside and we buy calls? Yes, it would be a good trade because it's justified, because your first rule is to wait for the breakout of pre-market and breakout of after hour high or low to happen, and then you enter the trade, right? Now, I'm not going to get into the ATRs of things yet, but ATRs do matter in terms of you entering a trade at a specific price. Now, going back to the whole pre-market after hour thing, you have to also understand that price action, like I said, is volatile in the morning, and it's okay to wait for because sometimes, how many of you ever feel like, oh dude, I don't want to wait for it to come up here because I feel like it's already making a big move, and I don't want to I don't want to get caught in you know as it's possibly coming down because I didn't get to enter it once it's making a big move. How many of you ever feel like, fuck dude, this thing's already going up so much, why should I wait until we get up here or down here to make a trade? Now, how do we solve that? Right? There are multiple ways to get rid of that feeling that you're going to miss out on it, or that it's already, going to move too much. Number one is this. Number one is understanding ATR. What is ATR? ATR is the average true range of a stock. So how do you find an ATR? An ATR is it's a number. So if I say SPY has an ATR of $4, it means that every day it has an average of $4, meaning it moves about $4 every day. What's one way we can find out? You can look it up online. There's websites where you can find out, or I don't know the study that it has. I had it one time, or you can just, go on the daily chart and, take the last 3 months like that and just do it manually, where you're counting the distance between the top and bottom candles. So from 377 right here to 371, how much is that in dollars? How much is 371? Okay. And then this one, 392 to 386, how much is that? $6. How much is 389 to 383? $6. What is 406 to 398, 399? $7. 415 to 410, $5. 427 to 421, that's $6. From 420 to 413, $7. From 404 to 397. So all you do is this, right? All you do is you can just do that, or you can go online on finviz.com and look at that. But you have to have an idea of all of the ATRs of all of the names you want to trade. I can tell you like 3, 4, 5, 6 names where I can give you an ATR of it. Like Tesla can have Tesla at the pre stock split had an ATR of like $15. SPY has an ATR of $5. Amazon has an ATR of $3. Apple has an ATR of $3. So it's almost like how do I know these ATRs, right? How do you think I know these things? How do you know these types of things? By trading every day and charting every day. Like literally, if you chart every single day, you'll know in the next month or two. And because I traded every day. How many of you have that? If anyone has that ATR study, can you please link it in here? How many of you guys want that? You can add it to your chart. It's fucking useful. But okay, so now understanding ATR is one. Why is understanding ATR key? Because if you know that SPY moves $5 a day, if you know that SPY moves $5 a day and the distance between the pre-market high and the pre-market low is only $2, how much more can it go once it breaks out of the high or the low? $3. Is that enough for you to trade? Of course. $1 on SPY is like $1 is like 50, 60%. So if you have another potential $3 you can trade, you can still get a good 50 to 100% out of a trade that you can take once your setup comes along. Does that make sense? Now, once the stock is running out of room in terms of ATR, that's when you got to be careful and you got to back the fuck off. Some people don't know when to back the fuck off. How many of you have traded a stock that's already moved a lot and you're like, I'm going to fucking trade it? And then what happens? And then it goes against you and you're like, bruh, I just got spankarooed. Like, bro, you're not going to get spankarooed if you understand these things. Okay? This is just one simple thing that you have to understand clearly and know in the back of your head that every single stock has an ATR and you must follow that. Okay? So that was one reason, right? I'm like, okay, well, this has an ATR of $5, $6, so I can just fucking wait, right? Now, after it made this down move, I waited, right? I waited to see if it would even come down here. So once it made this down move and it bounced up, why did I not trade the reversal up? Why didn't I trade this reversal up? Anyone guess? I didn't trade the reversal up because there was a resistance level right here. The resistance level is too close for me to profit off of because obviously, right? Listen, so when you're trading bounces like this, right? Usually what you do is this. So usually when you have, you know, when you have a candlestick do this, and you have a candlestick go down and then it's hitting a support level and then it's coming up like this, usually you want to wait for you to trade the upside. What do you think, a simple rule is? At what point should I enter this trade to the upside? Like, let's say you have a down move like this. Because this is support, right? A simple rule is for you to wait for it to come above this candlestick. That's all you're doing, right? It has to first test the top of that candle for you to enter the trade. And once it breaks, then, you can make the trade if you want to, or you can wait for this one to break. But it depends on the distance between here to here. If this is too much, then you can just wait from here to here. Now, going back to the chart, I would have had to wait for this to break. Am I wrong or am I right? If I was going to wait for this to break up here, right? If I'm going to wait for this you guys, save the questions for later. If I'm gonna wait for this to break right here and I'm gonna enter right here, do you think there's enough room for me to profit from here up until this resistance level? Not really, because I don't know how fast the next candle is going up by, right? And I don't know at what point it's gonna reject, because obviously, remember this, another example, and this is key, this is a gem. When you have a resistance or a support level that's like this, when they bounce, sometimes they're not gonna bounce exactly where your level lies. Sometimes it'll go like this, it'll go like that, it'll go like that, it'll go like this, it'll go like that, it'll go like that, go like this, this, this. Does that make sense? Look at what I'm circling right here. What is that? That's room, right? That's room. So when you're looking at here, did we bounce exactly at 399.85? Or did we bounce somewhere along the lines of 399.68? 399.68. So it's like I didn't have enough room. Now, I waited, and once it rejected right here and it came back down, right? Once it went right here and it came back down, what did I do? That's when I looked at it and I was like, okay, now we're getting a rejection. Okay. Now we're getting a rejection, because what you have to understand is you have to focus on how the candlesticks look, right? So first off, you had a bounce right here. And then what happened all through here, right? What do you see all through here? Right here, right here, right here, right here, right here, right here. All you see is lower wicks showcasing buyers, right? Showcasing buyers, but the price kept coming down. So what does that tell you about the supply and demand at this moment, during these 30, 40 minutes of price action? This means that essentially, if you see that the price is coming down, then that means the buyers aren't really doing much. Does that make sense? Now, we did have buying come in here, but it wasn't even enough for us to come up to the next resistance, until the sellers just came in and completely rejected the price. Now, another thing that I want you to see is this. This is what you have to pay attention to. So if this is our next line of resistance, you have to look at the candlesticks that were trading along these lines and what they were doing. So if you look to the left, what happened at this? What happened right here? We're going to start. We always go from left to right. What happened here? Okay. What happened here? Okay. What happened here? What happened here? Okay, cool. We finally broke out here, right? Just one time. Number one. Then what happened here? Okay, we broke out here. That's two. Now what happened here? Rejection. What happened here? Rejection. What happened here? Rejection. So 1, 2, 3, 4, 5, 6, 7. 8 versus how much? 8 versus 2. You have an 8 versus 2 situation. Remember, just like life, trading is all about what? Trading is all about odds, guys. Odds. Someone said dominance. Odds. Trading is about odds. So when you're looking at odds here, the odds of the stock coming back down is higher than the odds of the stock coming back up because of how many times we rejected that specific level. So when I saw this, I was like, I'm gonna trade this rejection to the downside because we've had our chances of coming up, but we failed to do so. So what I'm gonna do is I'm gonna trade the rejection to the downside, and then I'm gonna use the pre-market what? The pre-market low as my target. And did that trade work out for me? You know, did it pay off that I waited to attack the market, waited for the market to do its thing? Because okay, so back to how you avoid fakeouts is you have to pick and choose your battles, right? You pick and choose your battles. And in order to do that, right? In order to pick your battles, you have to know that you have to know how the market works, especially at the open. The market is always volatile at the open. And so if it hasn't broken the pre-market high or the pre-market low, then you should not trade the breakout. I mean, you should not trade while it's in the pre-market high and the pre-market low. Does that make sense? So in this case, okay, yeah. In this case, it wasn't okay it was okay to not wait for it to break the pre-market range because we've already passed that time frame of volatility. The only reason why I'm still unclear on why you took that trade. Okay, so who is clear on why I took this trade and who is unclear? For those of you that are clear, why are you clear that I took this trade? Someone explain to me. The main reason why I took this trade was because, okay, so what's the time frame of volatility in the market at open? No, the time frame of volatility is either the first 30 minutes to about the first hour at most. And then when does it get really volatile again? At the end, the last hour. So it's already past that first hour mark. Now, after the first hour mark is when it's when the stock will choose its direction. Now, that only applies when you have a stock that cannot break the pre-market high or low. So if you have a stock that cannot break its pre-market high or low, then you must wait until the volatility ends so that the stock can choose a direction. Does that make sense? In this case, the direction is to the downside because we not only, so look, we had, we had the high of day, right? And after we had the high of day, we came down and we couldn't even get back up past the first resistance the first time. Now, that was still within the first hour. Now that it happens again, and this time, if you really pay the fuck attention to the levels right here, right? If you really pay attention, the rejection here versus the rejection here is this one lower than this one? This is lower. Everything matters. You gotta fucking pay attention to these things. Some people don't even look at this. People don't even look at it the way I look at it. Right. And then people wonder why I'm so freaking profitable every day. And it's like, how the hell can you find these plays and then it just goes your way right after? It's because you have to be patient. right? You have to be patient, and you have to notice things that people don't normally notice themselves. That's how you have an edge in the market. If you are able to dissect what you see right before your very eyes, right? You have to be able to try to see this from a perspective of someone who is trying to understand how everything works. So pretend this is a watch, right? I pretend like every single day. I pretend the market is like a watch, and I'm trying to break it open, and I'm trying to understand and see how every little thing works. If you are trying to understand how every little thing works, aren't you gonna have aren't you gonna find some things that the normal eye can't see? What you can see, like for example, if you break open, for example, some people when they're trading, they just look at the watch, right? But if you break open the watch and you try to see and understand how it works, aren't you gonna know things that people who don't break open the watch, like for example, let's take this example. Let's say you have a watch enthusiast and then you have a watchmaker, right? So a watch enthusiast can name every single fucking watch out there and why they're good. But a watchmaker can name every single watch out there and why they're good, but they can also tell you how the watch works and every little fucking piece that's in there. So if you're able to break down the charts and break down the price action to where you can understand how every little fucking thing works, right? Aren't you gonna have more confidence when you start making bigger trades or just making trades in general? Because when the more you look at this, the more you understand it. Get it? Right. So not a lot of you will understand price action, but you will once you create repetition. If you continue to look at charts, you'll understand it. What I'm telling you, it's not that hard. It's not that hard. It's not rocket science, fellas. What is price action? Is it wicks? No, price action is what you see right in front of your eyes right now. That always confused me too. People are like price action, price action. Price action is how the market moves in terms of candlesticks. Price action is these wicks, these rejections, this bounce, this reversal. That's price action. Price action is what's happening in front of your eyes instead of looking at indicators to tell you where the direction is going to go, right? So, for example, you guys want to okay, so this is the definition of price action right here. So price action is knowing that this rejected 7 times versus 2 times it came up. I mean 8 times it rejected versus 2 times it came up, and then knowing that the distance that this rejection versus this rejection, there's space between these two, right? There's space between that and between that. This rejection was lower than this rejection, right? And then price action is knowing that we had multiple wicks down here to try to get the price to come back up, but the buyers failed, right? Therefore, we rejected the second time, and this time lower than the first time. Okay. Price action is also knowing volume or little, like this, like trend line. Like, for example, this in itself was a trend line. That's a trend line that broke. Just things like that. That's price action, right? By the end of this class, I'm telling you, you guys will understand price action and you'll get it down. So when exactly did I enter the trade, and how did I know when to get out? Okay. When exactly did I enter the trade? I'll give you a timestamp right now. So I bought my boy. I bought 300 contracts of SPY puts, 398s for 125 at 10:59. So that was around, when is 10:59? Somewhere around here. So somewhere around here and here. So As this candle was forming, I bought puts. And then I sold some right here. I sold it right here. I sold it during this candle. So I bought as it was coming down here, and then I sold as it was coming down here. Now, after the first hour, right? After the first, and why did I sell down here, for example? Why didn't I wait for it to potentially come back down? Did I know this bounce was going to happen? And did I know it was going to come back down later on? No, I didn't know. But why did I decide to sell here? Like, for example, right? This highlighted, what I'm highlighting right now, that was a 40% fucking trade. Now, why did I not continue to hold? And why did I decide to sell exactly right there? Okay, some of you had very good answers. So here you go. Here's the answer. This pre-market level, right? So as I was trading, right? Because of the move that it was making, right? It's making down moves. I was assuming that as we were breaking this pre-market low, that it was going to create a bigger move and that more volume was going to come in. Okay. But what do you notice about the volume as this candle was forming? So once this candle formed, what did I do? I sold. But if you look at the volume bars, okay, what made me assume that this was going to continue going? So through experience, when you have pre-market breakouts at the open, you'll get big. You obviously will get bigger volumes, but crucial levels, because I only trade breakouts, right? So from experience, I've noticed that when you get breakouts of key levels, you usually get a higher than usual volume, and it will create bigger candles to the downside, and the momentum will start pushing to the downside, in this case, to the downside, right? But what was missing from that equation? It was missing the volume higher than usual. Do you notice the volume bar on the bottom? Do I need to friggin' make the color? Okay, there you go. What do you notice about the volume in this candle as opposed to the previous candle? The volume wasn't as high as when it was trying to break out the first time. Obviously, if it broke out, but it wasn't enough for us to come back down to here. So when it made the wick, because understand this, right? So when I'm trading, I have levels that I'm looking for, right? So obviously I entered here, right? So somewhere around here was a profit target of mine, but where was my next profit target after that? My next profit target was down here. So usually what happens is when you have a breakout of one target, your next target should be your next support. So all this empty space should have been cleared right here. Does that make sense right there? All this empty space should have been covered by the candles. Like it should have fucking went all the way down instead of it coming up. So the fact that buyers even came midway through these two levels, the fact that buyers came scared me off to the trade. And I was like, fuck it, I'm up 40%. Let me just trim and sell. On top of that, when you're up over 30%, you should trim in general. Does that make sense? So once this candle closed, right? 2 minutes later, as it was coming back down, and then as the candle started coming, as the second candle, so I sold at 11:08, right? So 11:08 was during this candle. Now, if 11:08 was during this candle, I sold probably as it was forming that hammer a little bit, midway as it was forming the hammer right there. So it was coming down and it was coming up. Now, why did I sell here and not hold, right? And because, like, for example, why did I not think that it was going to continue to come back down? Because the support that it made was higher than the support of this candle. Does that make sense? This and I'm telling you, the trade that I made was a great fucking trade because who would have fucking saw that coming? So look, that support versus this support. So if the support, if the next, and mind you, right, like I said, as it was breaking this, right, I was already, you always assume, the reason why I'm saying assume is because through experience, the momentum usually increases as it's coming down past a key level. But in this case, right, just like Eric says, there was no sign of continuation because the next support level was higher than this one. Now, if this candle did this, like if the candle instead, right, went all the way down below like that and had a support there, then yes, I would have held, even if it came back up on a hammer. But instead, it made a support higher than the support of this. So I'm like, fuck it, let me just take my profits because I am not gonna lose my profits. Like I'm up fucking 40%. Let me not lose it. And guess what? I sold at the right time. Now, imagine I held the whole way. What if I held the whole, like, for example, sometimes, some people do hold the whole way, but it's not very fucking smart because once we came back up here, I would have been down. Now, if you held the whole way and you start messing around with the support and you start doing this, would these rejections can have convinced you to continue to hold? Maybe, but this is the type of trade you don't want to get into, though. You don't want to get into a trade where you're stuck holding and staring at the market. You want an easy peasy ABC, right? Obviously, for example, right? If I enter the trade here and then held all the way through and held all the way down here, would I make a shit ton of money? Yes, right? Now, but what if you can avoid doing that and instead enter here and sell down here? Is there a difference between entering here and holding to here, then here, and then selling here? There's a big difference, right? There's a big difference because of the emotions that are gonna flow through you as you're waiting for this. There's a lot of less stress and there's more guessing if you were to enter here and hold it to here because there is a lot more hopium going on when you're entering right here rather than here. Does that make sense? Just like how there's a lot more hopium entering right here than entering right here and selling here than entering here and selling here. So what would you have done if you started looking at the market at 13:15-ish? I mean, if I had already made my money for the day, so I didn't even need to look at the market. But if I didn't trade, honestly, if I didn't trade, and like if I wasn't, like, for example, if I hadn't made a trade up until the middle of the market, I won't even look at the market again. There is no reason why your first trade should be all the way over here. Because if you trade like that, you're not gonna survive. Does that make sense? Do you think it's easy for someone to wait 4 hours to enter a trade? You got to think about it like that. What are the chances of someone sitting patiently for 4 fucking hours waiting for the market to create a type of resistance like this and for you to trade a reversal like that? No, the chances are slim. There's no way someone's going to sit down for 4 hours and wait. Sitting down for an hour, yes. Waiting for like what I did, yes. But waiting for another 2 hours after that, no. No fucking way. Okay. No, I took all my profits. I trimmed first, and then I took all my profits once I saw that it made another support. And I came out with 18. Does that make sense to you guys? Everything I just explained? How to avoid a fake out at the open. Now, key thing, right? Key thing here. So you always, 30% is a fucking golden rule, guys. 30% is a golden rule. 30%, if you're up 30%, always trim. And the reason is because I think of it like this. So if you put your money into a 401k and you let whoever trade the money for you and you base it off of the S&P 500, they're only going to give you what? How many every fucking year? 10%, right? 10%. Now, I think of it like this. So if the market's only going to give me 10% of my money every single fucking year, right? So if you have $1,000 in 1 year, how much money are you going to make in a year? $100. If you risk $1,000 on a trade and you make 10%, you just made what the market would have given you in a year. 20%, 2 years. 30%, 3 years. The fuck? Right? So why is 30%? Why is 30%? Why is it 30% and not 20 and not 40 and not 50? Because 1/3 is always possible on a trade. I always rule it out by threes. So 30%, my rule is 30%. And I've seen, and how many of you have made 30% on a trade before like that? Now, how many of you have made 50% like that? Not as many times as you made 30%, right? 20% is okay, but 30% isn't greedy. 30% is just right. It sits just right in your head. It's all, listen, everything comes down to your consciousness and how it sits right in your head. You have to pick a number that sits right in your head, just like how much you decide to trim, right? How do I decide, hey, do I decide to trim half, or do I trim all of it? Or do I trim 75% of it? Or do I trim fucking 1/4 of it? Right? When I trim, and this is how I trim, for example, I'm going to show you guys. So let's say, okay, so let's say my entry is here and then my exit is here, right? What I do is I divide, right? I divide the distance between my entry and my exit by 4. So do this. That's 1, that's half. 1, 2, 3, 4. Now, I divide between where I'm entering and between where I'm potentially exiting, right? And if you have two, okay, if you have from where you enter to profit target number 1, you divide by 4. But from profit target number 1 to profit target number 3, you divide those 2 spaces by what? 8. Does that make sense? From profit target 1 to profit number 2 is 1, 2, 3, 4. But then when you have, listen, some of you guys fucking suck at math, huh? Look, guys, look. Like, it's not fucking rocket science. Profit target number 1. Profit target number 2. God, I didn't even fucking graduate high school, bro, and I understand this. 1, 2, 3. So from profit target number 1 to profit target number 2, you divide by 4. 1, 2, 3, 4. And then from 2 to 3, that's another 4. 1, 2, 3, 4. Does that make sense? If I have 40 contracts, right? Every single time it gets here, what do? Minus 5. Here, minus 5. Here, minus 5. Here, minus 5. Here, minus 5. Minus 5. Minus 5. Until everything is gone. Now, at what point does this change? This changes when something like this happens. When something like this happens, that changes. Does that make sense? And if you have, and Samuel says, if you have only one, well, sir, if you have only one, then what? Guys, what the hell is the answer to this? If you have only one, then you take that profit, then you sell it. And that's the thing. If you have only one, then you cannot trim. Like, you just have to, you either have to take profits there, or you want to take that risk and fucking wait until the whole profit target. This is what kills people, and this is the greed. Because here's the thing, you only have one contract. And then now you're like, well, and then now if that trade, if you had a chance of taking 30%, but you didn't take it, who should you be mad at if it comes back up? It's your own fault that you didn't have more money to trade with. You get what I'm saying? This is why I say, when you're going to trade, you make sure you can afford more than one contract of that particular option, so that you can trim and you can catch the whole profit. But if you only have one contract, then that's on you. There is no secret trick to trimming if you only have one contract. Time frame wise, I'm looking at the 5 minutes when I'm day trading and I'm entering names. So look, going back to charting, right? Going back to charting, is there a golden rule when it comes to smaller accounts? No, not really. 30% is good. So I'm not going to teach you the Kevinacci. How many of you already know the Kevinacci? I'm just going to send a video on the Kevinacci. But I'm going to show you the normal way of making support and resistance. So this is what I'm going to end it with. So you start off with the weekly, right? Support and resistance is key. Support and resistance is the breath and life of your trades. You have to get your support and resistance levels down to the T. If you don't, then you're going to be, like, for example, do you think that, does it matter if you're 50% off? I mean, 50% off. If you're 50 cents to $1 off on a level, do you think that can be detrimental to whether you profit or not? Fuck yes. This is why you have to be to the T. So you start off with the weekly, you find the high point, and then you find, the next low point is here. I don't need to go all the way down here because, what are the chances SPY goes to fucking 280 in the next 3 days? So you find the top, you find the bottom, you find the midpoint, and all you're looking for is you're looking for the levels at the tip of the wicks. So you want to make sure there are at least 2 to 3 wicks, right? And then on the other ones, so look, 1, 2, and then 3, or 3 right there, right? Obviously, in the past, it's gonna test and it's gonna hit the bodies of the candlesticks in the past, but that doesn't matter. So wicks. Since I'm looking at the weekly, I only care about 2 touches. Sometimes one is fine as long as that's the top and that's the bottom of the chart. So now I have this. This, cool. Okay, I should be good right now. Now, it might seem cluttered to you, but when I pull up the 5-minute chart, it's gonna look like that. Right now, I move on to the daily. Usually, if you get it all right on the weekly, you don't really need to make a daily, other than like a few parts. But usually, I don't. If I'm doing it this way, that one, that one, that one. So we will always do the charting for all the stocks we're looking at before the market open, like what you do. So here's the thing. You have to, like, for example, I'll make my levels on SPY and I won't need to do it again tomorrow because I already have my levels ready, right? So like, look at this. So if look, I'm going to extend the time axis by 400 bars. So look, if tomorrow SPY ends up somewhere right over here, right? Do I need to make any more levels for the next 2 days? No, I don't need to. You only refresh levels once you're in an area where there are no levels. Can you do on a demonstration on how to buy correctly? What do you mean, Orlando? How do I show you how to buy something? To buy an option? I can't buy an option right now. How am I supposed to buy an option that the market is closed? I'll send you a video on that because I buy through my phone. Who here doesn't know how to buy an option? Yo. Like, you guys can YouTube that, right? Or do I need to show you how to buy an option? All you do is go to the option chain and you press buy. But if you guys want a video on how to buy an option, I'll show you. I'll send it to you. Okay. So again, every single day, right? Every single class. Okay. So I send out a syllabus of the topics that are going to be covered, right? So if you're in the chat and you're like, can you cover this? And that's something that I'm going to cover on day 7. Am I going to cover it now? Like, do you want a half-ass explanation of that topic now, or you want a full lesson on that topic? So please, if you guys have any questions on something that I don't talk about today, it's going to get covered. I'm not going to miss anything when it comes to me teaching something, right? I'm not going to miss how to explain something that is key to your success. I'm not going to miss that. What I'm not going to do is clutter 20 different things in an hour and a half, because you're not going to learn like that. When you soak in information, it has to be one by one by one by one by one. I can't just do everything at once because I'm going to miss certain information that I have to have an hour to talk about. So, okay. So today is basic charting. Okay. And I even talked about freaking even more than what was talked about, was supposed to be talked about. So let me, because I'm going off track. Everyone's asking me questions. So charting, right? Hourly, after the daily, you move on to the 4 hours. And then you move on. If you don't have anything on the 4 hours, you move on to the hourly. Now, I'm not doing it the other way where it's like my the elevator levels, because I'm not doing it like that right now. So I'm showing you the normal way. So I'm not going to be drawing noise levels on here because that isn't included in this type of making levels. I only make noise levels if I'm doing it the other way. Can you explain how you hold trades up to 100%? Okay. So last thing I'll talk about, because this is easy. So if you have an ATR on SPY that is $5 and SPY has moved $2. Okay, so let's say this is your entry, 394.58. And we open up right here. And then we break out, right? And then we have another $3 to go. Okay. And let's say from here to here is 100%. Okay. Now, well, from one profit target to the next, how many spaces are in between here to here? For example, like I told you earlier, 4. So if I'm going to trade this and I'm holding all of my contracts from here to here, I'll make 100%. That's your answer, right? That's how you make 100%. But is that smart to do? Right? Is it smart for you to hold all your contracts through everything? To me, it's not fucking smart to do, because sometimes we can come up here and then what's going to happen? We come all the way down. We can all come all the way back down here. So it's not smart. So after every fourth, you take off a fourth. So by the end, you're going to have, so if you have 10 contracts, if you have 8 contracts at the beginning, at the end, you're going to have your last 2 and it's going to be at 100%. Now, what happens if you trim? What happens when you get up here and you trim 4 and then it comes back down? When it comes back down to your previous fourth, you cut everything. Or you can cut another 2 and you can hold 2. And then if it comes back down to your entry and you have your last fourth, then you cut the trade so that you prevent yourself from going red at all. Does that make sense? This is how you trade safely and you prevent yourself from losing money. This is how you don't lose profits. That's the secret to being able to not lose any profits, even if the stock is going down as you're making money. The secret to keeping profits is being able to trim at these invisible levels, because these levels aren't there. But you're dividing the distance between your entry and your profit target by 4 as if there were profit target levels in between. And so you're trimming every fourth so that you can be safe and so that you don't end up, you don't end up messing up your trades or you're messing up your profits. Does that make sense? All right. Day 3, we're gonna do pattern analysis. So when we come back on Friday, we're gonna do pattern analysis. We're gonna talk about different patterns that happen on every single time frame and how to trade them. We're gonna also introduce you guys to the top seed strategy, to where you're gonna break down these patterns into different levels within the pattern. But tonight I'm gonna send you a video on, obviously I'm gonna send a couple of videos. I'm gonna send a couple of videos on charting itself and how you can make your own zones. And also I'm gonna kind of talk about zones on the next class, but I have a good video that'll explain what zones are, because they will tie in to you making your support and resistance, and how zones itself can be key in finding good entries and exits. But thank you guys for showing up today. I'll have the recording up in a few hours. I'll see you guys on Friday.